So I think yesterday was the worst day to sell covered calls, maybe ever. The markets were humming along just fine, right in this range right here, around 415, 416. And then as you can see, things just completely blew up. In this video, I want to be honest and transparent about some of the downsides to selling covered calls because sometimes you just don't know what's going to happen. And even when implied volatility is high and you're able to get a strike price way far away from the money, sometimes things just completely get out of hand. What's up, you guys? Welcome back to the Average Joe Investor channel. I always strive to be honest and transparent with what happens in my own trading account, especially when it comes to selling options and selling covered calls. And yesterday was a complete nightmare. As you can see here, at the end of April 8th, the markets closed at least for QQQ, 416.06 per share. And because of the extreme level of volatility, I was able to get a strike price way out at 438, which was approximately the 10 delta. And for that, I collected $74 per contract. And when the markets opened yesterday, April 9th, things were doing just fine, sitting right around 416, 417, 418, even had moved up to maybe 420, but 422, but really quite far away from my strike price at the time. And then right around, let's say, 10 a.m. Pacific Standard Time, 1 p.m. Eastern Time, President Trump on Truth Social announced that there was going to be a 90-day pause on the tariffs that had been recently announced. And the markets jumped from 424-ish to about 450 per share in about 5 minutes. And at that point, I probably could have just rolled right here and it would have worked out okay, but then things continued to stay high and elevated, and at the end of trading right around here, around 3:54 p.m. on the 9th, the market was trading at 463. Now, I had recently had an issue where I was deep in the money on a strike price for a covered call, and I'd worked through some different options, and I'd ended up rolling significantly at a deep debit. And so I'd worked through some potential alternative scenarios, looking at, instead of rolling from the 10 delta to the next 10 delta, rolling maybe from the 10 delta to at the money the following day, or just holding the line right at my existing strike price to collect a credit and see if the market subsides or comes down a little bit. And at that time, I decided I was going to operate the strategy of rolling to the at the money price the following day. However, none of those scenarios were really factored into a market rising by 11 to 12% in one day. So when I was looking at the different options available to me, this is what they looked like at the time. I had the 438 strike. I looked at rolling to 457 at the time, which was going to be about $12.75 per share, which ends up being $5,105. Which was pretty significant. That was to roll to the at the money at the time I was running the strategy. Alternatively, I looked at potentially holding the line, and this one, ironically, would have been the best strategy over a 2-day period. This was essentially rolling from 438 to 440. In other words, holding the line, and it was going to end up being a net debit of about a total of $400, $393.20. And then I looked at what I ultimately ended up doing, which was a middle of the road debit. This wasn't the final figures, I'll show that to you in a second, but essentially rolling from 438 up to 451, halfway between the existing strike price I had and the at the money price. And that was going to be pretty significant as well, a cost of about $4,473 at the time I was looking at this specific option. So in the end, I didn't quite have the cojones to actually hold the line and stay at 438, 439, 440 per share on that strike price. So I decided to go in between, and I went ahead and moved from the 438 strike price to the 448 strike price, which ended up being a net debit of about $3,700 right here. The thought process here was I didn't want to hold the line at 438, 439, or 440 per share and then have the market just completely get out of control over the second day, moving from 460 to 470, 480, resulting in a far more significant debit. And ultimately, if you were to look at the day over day results here, based on the incredible increase in value of my LEAPS contracts for QQQ and for IWM, my overall portfolio went up. Despite the net debit, it still was up about 10.23%, though it would have been up closer to 15 or 16% if I didn't have to deal with the net debit. And that was compared to the S&P 500 being up 10.44%, the NASDAQ being up 12, and the Russell 2000 being up 8.53%. Now, of course, we can never know the future. We didn't know what was going to happen today, April the 10th, but as we look back, here's what would have made the most sense. As you can see, the NASDAQ was down most of today, right? It was down to around 455, then it came down all the way down to a low of 434, and then it came back up as high as 444, 450, and ended the day right around 445, 446. And as a result, I was able to roll for a net credit here. My cost to close my existing contracts at 448 cost 286.72, and my new contracts for rolled out to the 11th at 459 around the 17 delta was a plus 805.25. So from a cash flow perspective, on the 9th, I was out 37.93, and then today I made back part of that at plus 611.69. Still a long ways to go. And if we look up here, you can see my cash flow for the day again, 611.69. My April cash flow is still in the hole, 1403, though I'm still positive year to date, 3466. The hard part about any of these decisions in real time is the emotional aspect, right? You can come up with all the rules you want to, but when you see a market move that you haven't yet experienced in your lifetime of investing, when you see a market go up in the middle of the day, all of a sudden up, 11%, up $40, $45 per share, some of the rules that you think about go out the window. Though in hindsight, if I had just held the line and rolled from 438 to 440, I could have rolled from 440 today up to as high as 450, 452, still for a net credit. So instead of being out over a 2-day period $3,100, I would have been plus 100. Now, that doesn't know, we don't know what the future holds, right? And it could still be a situation where I've set myself up well over the next few days. I don't know yet. But ultimately, the biggest takeaway I have is maybe at times it's best to just sit on the sidelines, right? There's nothing wrong with that. And in hindsight, I wish I had done that at that time. Second takeaway here is, I was able to start collecting even more income than I normally was. And I started to get, I guess, a little bit greedy here. Instead of just continuing to collect $200 to $300 per day, I went ahead and went to $400 and $500. Now, honestly, it wouldn't have saved me in this situation. I still would have had to deal with an issue yesterday because of the dramatic move up, but it wouldn't have been as significant. And maybe some of the rules I had in place would have served me better in that type of scenario. The majority of the time, selling covered calls is a great strategy to utilize. And every once in a while, though, this type of situation can really mess you up, which is why it's critically important to, number one, have rules in place for how you handle these types of scenarios. And number two, maybe more importantly, you need to follow your rules, regardless of your emotions. And now that I've had this situation come in, it's been a great learning opportunity. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to as many of those comments as possible on the day I post a new video. And I'd love to hear you guys' feedback on maybe the situations you dealt with selling covered calls in this last 2 or 3 days and how you handled that situation as well. Make sure to leave your 2 cents down in the comments below. That's all I got for you guys. Have a great rest of your day, and thanks for watching.